Hi, Akshay Shrimanka here from Shea CPA. We help early stage tech companies with their accounting, bookkeeping, and tax compliance. And I thought I'd record this video to go over our latest blog post, Startups, What's Your Burn Rate? So this is an illustrative example of a tech company we worked with in the past and showing you how we calculated their burn. So what I have up on screen here is a statement of cash flows. The statement of cash flows is one of three main financials, which is the balance sheet, income statement, and the statement of cash flows. So the statement of cash flows is broken up into three areas: operating activities, which mostly focus on the income statement items such as revenue, COGS, gross profit, and the operating expenses to get to your net income. And then we have the net cash provided by investing activities and financing activities. Now, the financing activities is important because this is essentially where the money that was raised during the year, either through some sort of a financing round or loans, would be placed. So in this company's example, if we look at their operating burn, you could see that there's quite a bit of variability from month to month, which could skew burn rate calculations. Because if we just are looking at the burn rate for January, from an operating point of view, it's 200K, and then February went down to 23. So what we usually do is either look at a trailing period or the financial projection or the business model to calculate what that company's actual burn is. So in this case, what we did is we took the 12-month period and we divided it by 12, and we got an average burn for the year of about 106,000 if we're just looking at the operating activities. Now, the revenue is already factored into this net income number, so it's already baked in. So that kind of gives us an idea of what the average burn is. But if we look at the cash on hand at the beginning of the period, it was 610,000. And if you look at the financing that happened during the year, the total was 1.26 million. The financing, if you look at it, it's spread out across the year. It's not all in one or two tranches. It was like multiple tranches of investment that came in during the year at different points of time. And this can sometimes be the case. Sometimes it's more just in 1 month, as I mentioned. So total money that they raised plus the beginning cash on hand, they have 1.87 million. And if we just divide that number by the average we calculated, the runway would seem to be 18 months, but that doesn't really give us an accurate representation of what the runway would be on any given month. And for that, what we usually do is look at the ending cash on hand and divide that by our average burn, and that would sort of give us an idea of how much runway we have based upon the cash we have on hand. And as you can see, this company never had 18 months of runway at any given specific point in time. And in fact, it always had 6 or less months of runway. And in September, it actually had 2 months of runway. So for you as a founder, I think calculating these numbers on an ongoing basis is extremely important. It lets you know the timing of when you need to be fundraising. And it's also a critical metric that you need to be able to provide to advisors or your investors and board. So we help founders calculate these numbers and stay on top of what the actual burn is and what the actual runway is. And hopefully you found this video informative. And if you have questions, feel free to reach out, and thank you.